Good evening. This is Ken Long from Tortoise Capital Management with a review of the weekend trading report for April 20th, 2013. And we've got a bullish, volatile market. Not surprising, responding to the events in Boston. On an annual basis, using weekly RSI 14, we're at 61 out of 100, so at the high end of neutral. This is pulled back from 74, which was overbought on an annual basis last week. The 10-day NDX is showing low end of neutral at 29 out of 100. Looking at the market mosaic indicators, the percent stretch relative to the 200-day moving average is down to 7.93%, which is white bullish. The slope of the 50-day moving average has rolled over to yellow neutral here at 0.36%. ADX remains a non-trending neutral at 17.2. ATR percentage is in the volatile range now at 1.21%. The risk-on indicator, which is the 30-period moving average of the VIX divided by the 10-period, is in the risk-off mode at 0.94. The z-score of that reading, compared to the last 5,000 days, is in the yellow at minus 0.84, and you can see the time series of that over the last 30 days, and now we're deep into risk-off. No change to the blended monthly rebalancing portfolios. The 26 portfolio remains with mid-caps, Japan, and financials. The 13 ETF portfolio with mid-caps, Japan, and small caps, with the next reevaluation due on or about 1 May. In ETF2, the theoretical exposure is at 70%. The model portfolio remains at 100% exposed, and this week all we need to do is update stops. The current readings on blended monthly portfolios: 13 ETF is Japan, U.S. real estate, and mid-caps. You'll notice that the diamonds are outperforming the broader large cap index. Technology remains very low due to the Apple effect. In the 26 ETF portfolio, it's Japan, real estate, and financials. You notice about half of the symbols now are on cash positions, being below their 4-month moving average, with a lot of these being the globals. You'll see Europe, Swiss franc, emerging market bonds, Brazil, Latin America, and so forth. The summary of the ETF2 large regionals, again, you see 3 out of the 7 are on cash positions. That's why we're at 70% invested, 30% cash in the theoretical model. In a bull volatile market, we have SPY. The U.S. is better than the globals, with the SPY at 66 and the globals at 63. Thus, the U.S. is still in charge here. We had a change in the order of strength inside the U.S. Mid-caps remain the strongest at 68, but now it's the large caps at 66, followed by the small caps at 65, and the technology at 61. The 2 strongest sectors are still Japan and mid-caps, and then the 2 weakest are Latin America and emerging markets. Inside the world market model, we have all of the U.S. is now above average. The mid-caps had been in green last week, and they've cooled off to being simply above average. Japan remains the strongest, joined by selected Asia less Japan and Philippines, Indonesia, and Thailand. Private equity has cooled off to come back to just above average. All of the rest of Latin America and emerging markets are below average. Most of Europe is below average. Inside the business sectors, again, the U.S. is dominating, or at least tied in the case of materials across the board. The strongest sectors are the defensive plays, staples, utilities, and healthcare, and that's reflecting a limited risk on trade among the large cap mature companies that are making money. The top 30s in the ETF2 database remains Japan, biotech, consumer staples, Philippines, healthcare, utilities, Thailand. Those that are in the white inconsistency but green in strength are symbols that are adding current strength, and so that's they're on the move up still. That would be Japan is still strengthening, as is natural gas, or as are natural gas, healthcare, utilities, and consumer staples. All of those are very liquid. XLP remains a dominant position inside the ETF2 database, for example. All of these that are green on strength and white on consistency are ones that are getting measurably stronger. The Pacific high yield or high dividends, global real estate, Vanguard real estate, emerging market technical leaders. Among the Dow 30, Hewlett Packard, we noted last week, seemed to have cracked. It's now down below in the low end of the 18s. It's been replaced in the top by Verizon. Pfizer continues to be strong. The three that are really increasing now: American Express, Coca-Cola, and AT&T. You can see are green on strength, but just white on consistency. That's a sign of emerging strength. Walmart and McDonald's have moved off the bottom and are now up into the green. Alcoa and Caterpillar changed positions. Now Caterpillar is worst, but they're the only two Dow symbols that remain in the red. That reflects a broader strength in the U.S., but weakness in the materials and industrial sector. JP Morgan is moving its way towards the bottom of the stack here. It's green on consistency, but now solidly into the white on strength, and that's a sign of losing strength. That's a symbol that used to be in the number 2 position a short 7 or 8 weeks ago. We'll shift now to the daily report. See, the time series in the 10-day NDX has pulled back to just above the oversold condition. Diamonds are on an overreaction signal. See the increase in volatility because of the events in Boston. Low level of trendiness inside the market, but now the bears have moved up in charge lately. The 10-day max pain winners, or those high priority targets, are going to be Hewlett Packard, IBM, General Electric, Caterpillar, Bank of America. The 10-day min pain, these are the ones that are winning: American Express, Disney, Verizon, Procter & Gamble, and Pfizer. We have channeling and overreaction signals in energy, industrials, and diamonds. And then among the Dow 30 stocks, channeling in Hewlett Packard, General Electric, United Health, McDonald's, and plenty of overreaction signals in the Dow also: Hewlett Packard, General Electric, United Health, Bank of America, Chevron, McDonald's, and Cisco. 5-day down pattern in AT&T, triple screen pattern in McDonald's, 551W patterns in United Health and Travelers. And then we have quite a few symbols that are on the auto framer based on trade location, better than 2 to 1. Gold, silver, oil, IBM, blended commodities, General Electric, Caterpillar, Euro Asia blend, and Europe. Many excellent targets to choose from inside the Dow. You can see plenty of things test out at better than 2 to 1 in the auto framer, or top 5 in the max pain range compression. No surprise again: Hewlett Packard, Caterpillar, General Electric, United Health, and IBM. Those top 3 are also in the single digits on RSI2, and Hewlett Packard is a 3.2 on frog quality numbers, so it has plenty of things going for it. In that low single digit RSI, we would also looking to add IBM, McDonald's, and Cisco. So plenty of symbols to choose from. A couple dojis here in Alcoa and JP Morgan. Almost 2/3 of the ETF 30 are testing up properly, better than 2 to 1 on the auto framer. A couple dojis, a couple channeling and overreactions in energy and industrials. In the top 5 among the max pain range compression, notice gold at 7 to 1. Silver at 7 to 1. Gold at 11.7 to 1 with a frog quality number of 3.1. That has to be on your short list. excuse me, that's oil at 6 to 1 with a 3.1 frog quality number. 551W and an overreaction signal in the Dow, which comes in at 3.6 to 1. So that's going to be a favorable target. Just found a little bit of support here at 154 on Friday, but you can see that the regression line slope has rolled over, is still well below its 10-period moving average, and is now below average compared to the last 6 months and approaching flat conditions here at the dotted line. And you can see the downtrend here with a series of lower lows and lower highs. That's a generally weakening of the U.S. equity markets as the year rolls on. Percent stretch relative to the 200 has pulled back to 6% away from 12%. So we're 6% off the top and approaching sideways market here in about 5 or 6%. Among the Z-scores, see the continuous strength in XLP, outperformance in Microsoft, resisting the drag here lately, and then the still dominant strength inside Japan and the VIX. Looking at the price with respect to the river, you notice we've had 1, 2, 3 legs up, and each one of those, that leg came back and tested the bottom shore of the river. And that's where we're at right now, as we talked about last week. So this looks like either a turning point in the market where we get this kind of pullback another $6, or it finds support here and then has room to make a move up here. You'll notice that the size and the length of each of these legs gets smaller, and so this is looking more like an intermediate top. When we look at the slope of the regression lines, the 30 has come back to the 0 line just about. The 10 period is at the bottom of the channel, and the 90 has definitely rolled over and is approaching back to the river. So the moment of outperformance over the last 90 days is coming back towards normal. However, the fact that the 10 is at the bottom of that channel, which is where it's found support the last 2 times it was there, and in each case supported a bounce, suggests that this is a moment that is reasonable for a bounce. I'm actually expecting something like a relief rally on Monday due to the resolution of the immediate concerns in Boston for safety, with nothing worse happening. So I actually have a nice long bias right here because of the pullback provides an investable moment. And we'll just flip through a few reference slides, and you can slow that down and look at that more carefully at your leisure. And that's everything I want to cover right now for the executive summary. Plenty of nice swing trade targets going into Monday, and I think with a relief rally that we're going to see a nice trading day on Monday. And keep your powder dry, and keep an eye on that energy sector and in the industrials. And then among your key favorites, Johnson & Johnson is the stock of choice going forward. Just a powerful growth stock looking story right there. So take good care. This is Ken Long, Tortoise Capital. Keep your powder dry and your risk measured.